So morning everybody, and thanks to the large number of you that appear to have braved coronavirus to attend today, and also thank you for those that are attending today's results presentation remotely. Thanks for your continued interest in Ultra, and welcome to our full year results presentation for 2019, which I think was a good year for Ultra. You'll hear a chunk from me on strategic and operational highlights of the year. You'll then hear from Jos on my left, who's now been with us for 3 months, and this is his first results presentation, so be gentle with him, Sandy. And although he only joined in December, I'm pleased to say that Jos has brought a level of curiosity and discipline to Ultra, and the organisation is already responding well to his experience, to his energy and to his focus. And just for clarification, whilst Jos is already very influential in Ultra, the picture on the screen of this wave is actually about the building momentum that we see in Ultra and has nothing to do with Jos's passion for big wave windsurfing. Anyway, Jos will give you some initial views of what he's found, and then is sufficiently up to speed to give you quite a detailed look into the financial highlights of the group, and then I'll wrap up at the end. 2019 was really about building momentum. It was a busy year for the organisation, and I'm pleased to say we delivered robust revenue growth, driven by both buoyant market defence spending, particularly in North America, and demand for our technologies and capabilities, which are proving important in addressing today's evolving threat environment. Gross margins were broadly stable, and despite the impact of increased costs associated with our transformation programme, as well as a more disciplined and prudent approach to assessing and recognising programme risk, we also saw good profit, earnings and return on capital progression. Our focus on more effective working capital management resulted in a 12% improvement in average working capital turns during the year. And if I'm honest, cash generation was actually a bit better than we anticipated at the beginning of the year, and Jos will touch on that in his section. And then, reflecting the good 2019 performance, confidence in Ultra's exciting prospects and our approach to capital allocation, the board is recommending a 5% increase in the full year dividend. Also in 2019, Ultra's transformation is well underway. From an aggregation of broadly independent small businesses to a cohesive and efficient solutions provider. We've defined and launched a common vision, mission and set of values for the whole of Ultra, and the culture in the organisation is already beginning to change. We've developed and defined a focused strategy built on our unique strengths, which we shared with you at our Capital Markets Day in January, and our multi-year transformation programme is up and running, and we're making good progress. And we enter 2020 with strong momentum and a positive outlook. Our major markets remain good, and we've got nice visibility with a healthy order book, which is up nearly 11%, and with stronger than usual order cover. We continue to identify longer term opportunities for accelerated growth and improved efficiency. And whilst this will require further and multi-year investment in things like R&D, infrastructure and process standardisation and excellence, I'm increasingly confident of our ability to deliver outstanding value for all of our stakeholders over time, and that all our efforts in 2019 means that we really entered 2020 well positioned for accelerated change. So as you know, when I arrived at Ultra back in 2018, I found an aggregation of technology-rich but autonomous and tactical site-based businesses with good engineering capability and committed people. However, the business had poor connectivity. I saw pockets of underinvestment, and processes and practices and functional capability were those that were suited to the autonomous nature and small scale of the independent business units. There also seemed to be limited benefit, as far as I could see, from being part of Ultra. So to address that, we've developed a strategy which we presented to you at the Capital Markets Day in January. And for those of you that were unable to attend or just needed reminding, I thought I'd just reproduce it here. And this is a reminder of what Ultra will be. What do we do? Well, we're a trusted partner in key elements of mission critical and intelligent systems. What do we specialize in? Well, we're applications engineers primarily, and we're experts in the key technologies that are strategic to the delivery of those mission critical and intelligent systems. We operate in clearly defined markets, principally Five Eyes, maritime, communications and intelligence defence. Other defence markets where we can apply solutions that we've developed to address situations in our Five Eyes nations in a modular way to non-Five Eyes defence customers. And finally, selected and specific other highly regulated and harsh environment detection and control markets. And finally, we're focused on delivering accelerated growth and creating outstanding value for our stakeholders through the rigorous execution of this strategy and by delivering parenting advantage through the benefits of our Focus, Fixed and Grow transformation programme. And just as an aside, during 2019, you did begin to see the impact of this strategy at work. We sold 2 non-core businesses, Airport Services and Corvid Paygate, and additionally, just after the year end, a small non-NATO, nation-specific electronic warfare business. And whilst we don't anticipate that there will be any major changes to the portfolio in 2020, we do anticipate a couple of additional small transactions this year. And we're always looking at all of our businesses through a much more rigorous value creation lens. So I also thought it'd be worth reproducing this slide, which we shared with you at the Capital Markets Day, which really sets out in a bit more detail what our Focus, Fixed, Grow transformation programme is aiming to deliver. Firstly, it's enhanced growth through better strategic and customer-focused technology investment with more effective cross-group sharing and coordination in both technology and know-how to deliver the best solutions at the best price to our customers. We're also looking at enhancing and driving more coordinated innovation, reflecting rapidly evolving customer needs and the emerging and alternative technologies that can address them. We're using our close technical engagement to build more strategic relationship with both end users and with customers, better enabling us to understand their future needs and to provide them with a broader and more complete Ultra solution. We're investing in our talented people, and we're attracting, retaining, motivating and aligning them to support our new strategy and its delivery, as well as deploying them in the right place and at the right time where it creates most value for our stakeholders. And then finally, we are deploying the capital that this cash generative business generates and delivers in a much more disciplined way than we have historically, focused very much on long-term and sustainable value creation. I won't repeat it here, but Gabby has included our new approach to capital allocation in the slides in the appendix. Focus, Fix, Grow is also about improving the operational efficiency with which we deliver our products and services to our customers. And we see opportunities to improve this efficiency in areas such as scale benefits associated with not just more visible and coordinated procurement, sourcing and partnering, but also investment in better systems, processes and people. We anticipate introducing more efficient and automated back office and support processes. We're looking to drive improvement in our functional operating models to better support business delivery in a more cost-effective, information-rich and coordinated way. We're looking to use and better utilise our core competencies and capabilities, as well as our currently extensive physical footprint. And then finally, we are introducing a much more systematic approach to continuously improving and sharing best practice across the group. Hopefully this gives you an understanding of the change agenda that we're pursuing and the objectives that we're targeting and prioritising, all on the base of sustainable and better value creation. So now a bit of an update on how we're doing on that transformation programme. I'm pleased to report that we're making solid progress on most of our initiatives, and these fall into 4 broad categories. And what I'm going to show you now is our RAG chart, red, amber, green chart, of how we actually track progress against those initiatives internally. So firstly, on culture and talent, all green. We're basically delivering what we anticipated we would. We've defined and launched that vision, mission and values. We've made great progress in strengthening our people capability, particularly at the senior management level. And we've aligned, improved and standardised our people development and reward processes, and are investing in HR infrastructure and the tools that enable them. And this should improve efficiency, create more objectivity and greater visibility around our HR processes. In terms of the operating model, we've defined what we believe are exceptional value creation and what it means for our stakeholders in terms of specific objectives, and we've developed key performance indicators to measure progress against those objectives. We've set SMART goals and are in the process of deploying, focusing and aligning the operations and the functions to deliver them. And as reported at the Capital Markets Day, we've now completed our high-level organisational design work to change the structure of the group to better support strategic delivery. And we're making good progress in the process redesign that we'll need to implement to ensure this organisation is effective when it's launched in 2021. In operational improvement, we've made good progress on improving and standardising our programme and project management processes, and we've significantly improved the performance discipline and the level of operational oversight within the operating units and the functions, and we've embedded an increased return on investment focus and capital allocation discipline across all of our scarce resource allocation decisions. And then finally, in infrastructure, whilst we did get off to a slower start than anticipated in our information systems backbone, the appointment of a new Chief Information Officer in the second half of the year has meant that we've made great strides in standardising connectivity and commonising infrastructure which form the backbone of our IT information systems. We've also developed and launched an effective internal collaboration and communications platform, the Ultra Intranet, which is finally enabling our people to connect and share in a much more effective way. The costs associated with these initiatives have all been taken above the line and will continue to be taken above the line and all show good payback. But we will provide you with greater visibility on what these costs are and how they evolve over the years. And Jos will give you the visibility on the 2019 numbers when he talks through the financial highlights in a minute. So I'm pleased with the transformation progress we've made across most of our initiatives in 2019, but I have to confess it wasn't universally perfect. We have occasionally run up against unforeseen interdependencies or conflicting and constrained resource requirements. This is also a multi-year program, and so we have a rolling set of new initiatives which we undertake at the beginning of each year. And so to improve oversight, to prioritise better and to accelerate delivery, we have appointed a senior operational leader to the full-time role of Transformation Director. Nick took up that role in Q4, reporting to Jos, and we're already seeing the benefits of both Jos's input and Nick's rigour to provide us with better visibility, and hence, where we haven't perhaps achieved quite what we'd hoped, we are increasing the focus on a number of our initiatives in 2020. So again, in terms of RAG chart, on culture and talent, we are making good progress. The reason this is marked amber is not because we aren't where we anticipated we'd be. In fact, if anything, I think we're a little further on than I'd hoped. What it is, it's cultural change is difficult to deliver and therefore needs to be consistently monitored and a lot of effort focused on it. In terms of operating model, again, I've marked this amber not because we're not where we anticipate we will be, but because of the risks associated with a material design, operational design change, and changing the underlying processes that support that operating model. But so far, we are where we need to be. In addition, IR&D, innovation and investment, I think it's fair to say that a more disciplined and value-focused approach to what we invest our internal dollars on meant we got off to a slower start in 2019 than anticipated, which combined with some initial engineering constraints meant we actually underspent versus our plans in the first half of the year. But I'm pleased to support a pickup in momentum in the second half with investments in areas such as artificial intelligence, machine learning, and intelligent systems for unmanned surface vehicles continues to develop and position us well for the future. We do, however, need to improve our ability to innovate and innovate quickly. And so again, that's an area of more increased focus for 2020. Operational improvements to one area where I have marked it as red. So despite great strides in HR, in governance and in program management processes, we've probably made less progress across broader business process improvement than I would have liked. And this is particularly true in the area of our finance processes, our shared services, and our operational processes. So whilst we've significantly improved our understanding and mitigation of project and investment risk, we still have work to do to make it systematic. I'm comfortable that the risks that we are seeing and identifying in taking on new business are more than fairly reflected in the way we contract. I think it's fair to say that we did need to address a couple of issues in our maritime business, which are legacy contracts, where a more rigorous and prudent approach to both assessing and quantifying and recognising programme risk did lead to recognising an operational loss, and Jos will touch on that as well in his section. But based on the additional work we've done around those contracts and the prudent approach we are now taking to contract profit recognition, I'm comfortable that we've now prudently addressed all of our legacy contracts, although we must remember that things in a long-term contract business can always change as we execute. And finally, also marked red, whilst we did realise some benefits of scale, particularly around indirect procurement in the UK, we haven't made as much progress in either identifying or realising broader scale benefits that I would have liked, and hence it is red. This is partly due to the complexity of our business. It's partly due to the data and information, as well as the cultural challenges that we face, but it does feel like there's a decent prize ultimately to go for here, so an area of significantly increased focus this year. And then finally on infrastructure, also marked amber, principally because of our slow start to our IT investment, but that is picking up, and I'm confident that we'll catch up to where we anticipated we would be with further focus this year. We've got much more work to do on commonising applications, but that does rely on an effective IT backbone. And then finally, it does feel like there's good and probably more improvement opportunity through using more common underlying operational processes in our business. So whilst we did complete the 3 ERP installations we anticipated we would in 2019, we have decided to pause that progress whilst we formalise and standardise those processes that we're trying to enable with our ERP installation. So don't expect you'll see much ERP installations in 2020, and then that program will accelerate into 2021. But generally, and on the whole, I'm really pleased with how far we've got in the transformation of this business, and we're making good progress on most of our key initiatives. Importantly, momentum is building, and I'm beginning to see the culture change. And entering 2020, I'm pleased we've now got the resources, the oversight, and the tools to better assess and better prioritise and address any resource bottlenecks to make sure that we see greater pace and better prioritisation in our transformation in 2021. So that's the operational stuff and the transformation stuff. We shouldn't lose sight of the fact that in addition to a good set of outcomes and a nice progress on transformation, we saw strong order book growth, which was up nearly 11% on an organic basis. Clearly, it's helped by positive defence markets, but it also reflects demand for our underlying technology and capability. And we're seeing good order book growth across most of our businesses. Just to highlight some newer contracts that we've picked up in the second half of 2019. You heard about next generation surface search radar in the first half of the year. Whilst building on that success, we've received a contract to replace the legacy surface radar systems of the US Navy's subsurface fleet with a $100 million IDIQ to develop that surface radar for surface navigation radar for all of the US Navy submarine fleet. On Orion, we did receive our second large follow-on order. As you know, this is a multi-year $500 million program, which is part of the upgrade of the US Army's terrestrial line of sight communications infrastructure, and there's lots of good potential for that business going forward in addition to that IDIQ. On Mark 54, we got a nearly $50 million order on the Mark 54 nose arrays. That is part of a broader IDIQ, and I think the total contracted value is nearly $90 million so far, with a further 3 option years to go. And then finally, in our energy business, we signed the long-term supply agreement, which we referred to in the first half as being delayed with EDF, which ensures a supply of neutron flux detectors to them for at least the next 6 years. So all in all, good visibility into 2020 from that strong order book. And actually, I think order cover is as high at over 70% as it's ever been in this organisation. So not just good visibility, good order cover. And then finally, it's not just about the orders that we've won, it's also about the things we're looking at and bidding on. We've got a very solid future pipeline. We're actively engaged with both the US and the UK navies in supporting their desire to integrate unmanned intelligent platforms into their broader fleet, particularly in the areas of navigation and anti-submarine warfare. Our technology and success in supporting both surface and subsurface situational radar is providing us with much broader opportunities on both surface search and navigational radar in naval applications. Orion, we see significant further opportunity to expand our software-defined multi-channel, multi-band solutions which satisfies a broader diversity of user requirements and provides resilient network operations in congested and contested environments. And then finally, building our development work on upgrading sovereign, secure and NATO interoperability communications on Typhoon. We do see, which by the way we hope will lead to a UK production and support contract. We do see lots of opportunities to deploy that across the broader NATO air platforms. So these are just a few examples of the exciting stuff that's going on, not just in delivering orders, but also priming the order pump at Ultra for the next few years. So with that slightly longer than anticipated trot through what's going on in Ultra, I'm now going to hand over to Jos, who'll take you through the highlights of the financials in 2019.
Thank you, Simon, and good morning, everyone. Today it's 3 months since I joined Ultra, and it's an exciting place to be. Top-line growth is robust, and there's opportunity to improve Ultra through the focus, fix, grow transformation. In particular, I see real opportunity for improvement in the organisational structure, the optimisation and rationalisation of our sites, better direct and indirect procurement, and operational and functional excellence. Whilst I'm not yet an expert on Ultra, I have a good sense of the core challenges. We need to keep pushing the culture to drive change. We need to prioritise effectively in order to balance our growth opportunities against our efficiency initiatives. And we need excellent people to drive our growth agenda. We will also have to invest into the business to enable it to meet its full potential. Momentum is increasing in all of these areas. Overall, 2019 was a good year for Ultra. The closing order book increased nearly 11% organically to over £1 billion, the largest order book this business has ever seen. Revenue growth was strong, up 7.6%, 6.8% organically. Sales were £825 million. Underlying operating profit of £118 million was 2.9% higher organically than 2018. Margins were 14.3%. Margins fell a little due to increased investment of £6.1 million into transformation and R&D, the non-repeat of the one-off unhedged FX gain of £2.9 million that we incurred and highlighted in 2018, losses of £8.8 million in our maritime division, following the introduction of more rigorous programme management and oversight, and increased cost of incentives, all partly offset by the non-repeat of the 2018 cost overruns of £6.3 million in our Hurley business. Underlying operating profit before tax increased 3.8% to £105 million, and EPS increased 9.1% to 119.5 pence per share. We will recommend to shareholders that the dividend be increased by 5% to 54.2 pence per share, in line with our framework for capital allocation and reflecting our earnings and cash flow growth. Underlying operating cash conversion for the year was 73%, an excellent result given that we normalise our supplier payments during the year. I'll talk more about that later. Our return on capital increased from 16.2% to 17.8%, driven primarily by the increased operating profit and the amortisation of our acquired intangibles. The revenue bridge demonstrates the strong top-line growth across Ultra, with all of our strategic business units growing organically. Moving left to right, translational currency was a tailwind for us in 2019, increasing sales by £22 million. The £16 million in disposals relates to the sale of our airport systems business and our Corvid Paygate business. Both disposals are part of our journey to become a business focused on mission-critical and intelligence systems. Sales in our maritime business were up strongly, with organic growth of 7.8%. Communications and security grew 3.4%, and aerospace and infrastructure had a good year overall, with organic revenue growth of 9.8%. Turning to the profit bridge. Translational FX was a 3 million tailwind. The appendix to our results includes a ready reckoner on translational currency. As a reminder, a 1 cent move to the dollar impacts revenue by around 4.2 million and trading profit by around 0.6 million. The impact of IFRS 16 increased profit by 1.1 million. The sale of Airport Systems and Corvid Paygate reduced operating profit by 1.9 million. With regard to organic profit, Maritime's profit reduced by 3 million, with generally good underlying performance offset by the impact of the contract losses I referred to earlier. Operating profits in communications and security grew by 7.2 million, and aerospace and infrastructure was broadly flat year on year. Overall, underlying operating profit grew 2.9% organically to £118 million. This was an encouraging result against a background of some legacy-related contract losses and increased investment into transformation and R&D. As a reminder, our policy is to expense R&D unless the accounting rules require otherwise. I'll now walk you through the divisions. As we mentioned during the Capital Markets Day, we have changed our organisational structure from the start of 2020. In this presentation, I've used the existing names for the divisions. The new names of the divisions and the 2019 results restated in line with the 2020 structure are set out in the appendix. Demand for our maritime products is excellent, with the order book growing nearly 17% organically. Notable wins included the next generation surface search radar, which also helped Maritime deliver strong organic growth of 7.8% during the year. Operating profit decreased 5.4% organically. During 2019, we did a lot of work to strengthen our contract and program management processes. In Maritime, this included a cross-functional review by a Tiger team to review program risk and the estimated cost to complete our high-risk contracts. We also implemented a process to track our risk reserves and significantly strengthened the review of our key programs. This increases our confidence that estimated costs to complete on our key contracts are realistic. The increased focus on program costs resulted in one-off losses of £8.8 million. In addition, there was an adverse Sonobuoy sales mix compared to the prior year. Looking forward to 2020, we expect to see good revenue growth in Maritime, driven by sonobuoys, torpedo defence systems, and nose arrays. The Communications and Security division order book grew organically by 7%. This was primarily driven by the $500 million Orion Radio IDIQ contract, with around $46 million of orders received in 2019. Our radios business is very well positioned for the future. Revenue grew organically by 3.4%, benefiting from strong sales of ADSI, our air defence integration software, and greater demand for electronic and microwave products. Underlying operating profit grew by 22.9% in the year, up 7.2 million. This was helped by the non-repeat of the 2018 development cost overruns in Hurley. Hurley is now performing well and is moving forward with increased confidence. When the impact of the 2018 Hurley cost overruns are excluded, the organic profit growth relative to 2018 was 1.6%, and operating margins were broadly consistent year on year. In 2020, we expect to see further revenue growth in intelligence and communications, in large part due to demand for our radios and tactical command systems. In aerospace and infrastructure, The order book increased organically by 4.6%. Revenue increased by 9.8% organically, with sales in our aerospace business supported by F-35 and sales in our energy business disappointing, with delayed orders from our key primes. As expected, operating profit was down 3.2% organically, with good profit growth from our aerospace business offset by the non-repeat of the one-off £2.9 million foreign exchange gain in 2018 that we talked about last year, and by some margin pressure in our energy business. During the second half of 2019, we repositioned our energy business for softer demand, reducing headcount by around 40 people. The associated redundancy costs were taken in the divisional numbers. As a reminder, from the 1st of January 2020, this division is going to be renamed Critical Detection and Control and will include our forensic technologies business. The outlook for this division is positive. We expect good sales growth in 2020. Amortisation reduced significantly in 2019, down to £22 million. We expect a further decrease in amortisation in 2020 as our acquired intangible balance reduces. In 2018, the costs of the S3 programme were taken below the line. In order to align statutory operating profit more closely to underlying operating profit, we're taking the focus, fix, grow transformation costs into underlying operating profit. However, we do see the transformation as a discrete project which will come to an end in the medium term. So we will identify the transformation costs separately for you in future results announcements. There were no impairments in 2019, with improved valuation headroom compared to 2018. Overall, statutory operating profit of £94 million was up nearly £30 million, 44% growth on the prior year. Turning to operating cash flow. During 2019, there was a working capital outflow of nearly £17 million. As you'll see on the next slide, during 2019 we moved to more consistent payment days with our suppliers. If our days payable had been the same at the end of 2018, working capital would have been some £35 million better than it was in 2019. This time last year, we guided that the cash cost of normalising debtors and creditors would be about £46 million. The outturn was better than we expected because customers paid us promptly at the end of 2019, customer advances increased as a percentage of sales, and we made progress on inventory turns. IFRS 16 was adopted by Ultra on the 1st of January 2019 and resulted in £41 million of lease liabilities and £36 million of right-of-use assets being recognised. IFRS 16 had no impact on cash, but there is a presentational impact on the cash flow statement. The principal payments of £7.8 million on leases are now treated as financing activities. We have included them in underlying operating cash flow to improve prior year comparison. Capital investment increased to £23 million from £20 million in 2018, with continued investment in 3 ERP implementations and increased investment in HR software and plant and machinery across the group. Overall, operating cash conversion was 73%. We said that we would normalise payment terms during 2019 to remove the seasonality from our days payable. This chart shows the 3-month moving average of our days payable over 2018 and 2019. This demonstrates the smoother profile in 2019 compared to the prior year. Even with the normalisation of payment terms, our average working capital turns increased to 7.3 times, and net debt to EBITDA, including IFRS 16 and pension liabilities as debt, improved to 1.58 times. This is towards the lower end of our preferred range. This slide shows the movement in unbilled receivables. The top half of the chart shows how unbilled receivables of less than a year's duration reduced by £4 million against a background of increasing revenue. In a long-term contracting business, we're always going to have some unbilled receivables. The bottom half of the chart shows how our long-term unbilled receivables has reduced significantly, from £23 million to £14 million. Of the remaining £14 million, the majority relates to the A400M. We expect that program to have a good long-term future. This slide shows the walk from operating cash flow to free cash flow and from there to net debt. Free cash flow of £72.5 million was above last year, but on a consistent non-IFRS impacted basis was £64.7 million, marginally down on last year. Overall net debt at the end of the year was £154.8 million, taking net debt to EBITDA to around 0.86 times on a covenant basis. Headline net debt was broadly flat year on year, but now includes £41 million of lease liability recognition in accordance with IFRS 16 and the in-year payment of £7.8 million. We made good progress on pensions during 2019, agreeing a recovery plan with the trustees of £11 million a year until March 2025. This is the same as the previous recovery plan. The pension deficit has reduced by £37 million since the last triennial valuation in 2016. 2019 was the year in which Ultra returned to organic profit growth. The transformation is underway and we've increased investment in R&D. Looking forwards, we expect the positive momentum to continue. Revenue growth is supported by a strong order book. We expect broadly stable margins, with increased investment in transformation and R&D offsetting the tailwind from the non-repeat of 2019's one-off items. We're expecting ROIC to progress further in 2020, and despite the strong cash performance in 2019, we still expect cash conversion to be within our previously guided range of 60 to 75%. Thank you.
Thanks, Jos. So just to wrap up, 18 months in, I'm really pleased with the way Ultra is evolving. And 2019 was a year when we made really good progress thanks to the efforts of our people in changing our organisation and focusing on value creation. We've now got a strong team in place that's really challenging the status quo, is attracting talent, influencing behaviours at Ultra and driving change. We've demonstrated that we're a growing business with market and technology tailwinds and a clear and exciting strategy that gives us really good momentum. We've defined a multi-year and widespread change journey, and the transformation has commenced. We are already beginning to see underlying benefits in the way our businesses, our functions, and our people behave, interact, and perform. And the transformation programme is rich with opportunity and targeted at both accelerating growth and improving efficiency. So whilst it will require further multi-year investment in internal R&D, infrastructure and process standardisation and excellence, and clearly why we continue to monitor macro issues like the evolution of the coronavirus situation, which is not currently impacting our existing trading and where we don't see any long-term impact on our business. I'm increasingly confident in our ability to realise the exciting potential at Ultra and to deliver exceptional and sustainable value creation for all of our stakeholders. So that's the formal part of our presentation done today. I'm going to open the meeting up to some questions. Again, a reminder for those of you that are attending remotely. If you have questions you'd like us to address, please email Gabby or investor@ultraelectronics.com. And if you raise your hands in the room, Sarah will come over, give you a mic. If you could state your name and the company you represent, and then dive into your questions, we'll see if we can answer them.
Morning, thanks. It's Henry Carver from Peel Hunt. Just a quick one on the growth, the order book growth particularly. Obviously, it's a strong market backdrop. It's very strong growth. Can you give us a feel for whether you think you've outperformed your sort of target markets, or any sort of colour on win rates or anything like that to give a bit of colour around the growth? Thanks.
Thanks, Henry. I think at the Capital Markets Day we guided sort of to 2019 being sort of an in line with markets, and I think we sort of said our underlying markets grow at between 3 and 7%. We probably did a bit better on the top line than we anticipated at the beginning of the year, and certainly I think our order book growth was a bit ahead of where we anticipated it would be. I think we're guiding to sort of market performance or slight outperformance in the medium term and then outperformance in the long term. And again, intuitively and on an underlying basis, look, we're a pretty small fish in a pretty big pond. I do think we're probably doing a bit better than we anticipated on order intake. That's partly because my predecessors had started some of this more coordinated approach to interfacing with our customers. It's partly because our particular technologies and capabilities are very suited to the current and the evolving threat environment. And so I think generally we'd stick with our Capital Markets Day guidance of sort of market growth plus a little bit maybe for the next couple of years, and then you should see us accelerate after that. Thanks, Henry. Any other questions?
Morning, it's Richard Page from Numis. Could you just elaborate a bit more on these contract losses? Anything in terms of timing, how many there were, or how the process you've gone through discovering them, and also what that means for the rest of the business? Because I assume it means you've gone through everything with a fine-tooth comb on that side. And secondly, in comms and security, I'm assuming that Forensic actually had quite a decent H2 as well. I think there was some international delays in the first half. Could you just confirm that, please?
Jos, do you want to do a little bit on the contract losses, and then I might pick up and summarise on that, and then we'll talk about Forensics.
Sure. And actually, Simon had really kicked off the good work on kicking the tyres on contracts before arriving. In particular, I think Simon's done a really good job of setting the culture that this is a business where we want a sensible balance between optimism and pessimism in the way we look at the cost to complete of our contracts. And as we've kicked the tyres on the contracts, we have moved a couple of them to increase the risk reserves on them and make sure that we don't have any losses going forwards on them. But then on top of the cultural point, we've launched a completely new program management process, really building off the good practice in one of our business, and then we're rolling that out across the business. We've created what we call tiger teams, cross-functional teams, so that there's some peer review of some of these higher risk programs, so that there's some external challenge, or kind of internal external challenge, if you like. I immediately on arriving, we've had 2 different sets of calls with the CFOs saying, guys, if there's anything out there, now's the time to let the new guy know whether there is, and they haven't told me anything, so I'll be a bit disappointed if there's more to follow. We pointed our internal auditors at the contract management and bid process. That's the first time that's ever happened. So they went round about a third of the business and looked at those processes for us. And then obviously external audit has been really focused on this. They know it's an area where we're interested in. And actually they've done some really good work on kicking the tyres on the higher risk programs. Probably fair to say they've kicked them a bit harder than they had done in the past.
Yeah, I think, thanks, Jos. I mean, I think, Richard, these contract losses are different from the CWIP contract losses. So CWIP was an in-production program at the time where it was very clear that we had a material issue associated with delivery. What Jos has referred to and what led to the one-off maritime losses are slightly different. This is where we're adopting a more consistent and much more prudent way of balancing risk and reward. And I think it's fair to say that Jos has brought a rigour to that process, or a greater rigour and consistency to that process that might have existed in the past. We're in the long-term contracting business. We're doing pretty technical stuff. You can always get issues arising when you're designing stuff that's never been designed before. So I'm not saying we'll never realise contract losses before. What I am saying is the processes and the rigour which we go through to identify those risks up front are much greater now. They're not as systematic as I would like them to be, but we are reflecting those in both the way we price and the way we contract. And as Jos has alluded to, he's encouraged people to have a good old scrub of anything they know, and nothing more than we've disclosed has come out. So pretty comfortable where we are on that. And in terms of forensics, look, forensics is a pretty stable marketplace, and most of forensics performance isn't about beating that market because they're the majority of their market. It's about the timing of winning a particular contract. So I don't think you should read anything good or bad into forensics accelerated performance in the second half. It's a great business with lots of opportunity, and it's going to consistently chug away. Any other questions? Should we go to some online ones, Gabby, if we've got any?
Yeah, just got one from Chris Leonard at Credit Suisse. A question about supply chain and COVID-19. Could you please comment on the level of stock you currently have in place from suppliers, and what is the geographic split more broadly of your suppliers?
So thanks, Chris. In terms of COVID, what is COVID? It's our own business, forget that. Coronavirus or COVID-18, whatever it's called. We have done some internal planning, not just around supply chain, but also around workforce planning and productivity. I think we're not seeing any impact of coronavirus on us in today's trading, and I don't think we anticipate it will create any medium or long-term problems for us. In relation to the supply chain and inventory requirements, pleasingly, there are some clouds that have silver linings. Having done quite a lot of pre-planning for a hard Brexit, inventory levels were already increased associated with our key non-UK supply chains into our UK businesses. So we don't anticipate the need to put any further inventory into our UK businesses. We have looked at that supply chain. There is one critical supplier that sources a chunk of input materials from China that supports our aerospace business, but again, we're in pretty good shape in that regard. And I think to the broader question, Chris, most of our supply chain is situated in the countries from which we are delivering, and we don't have a huge amount of cross-border movement of supply. So generally, we've looked at it. We don't think it's a high risk. We think we've done what we can to mitigate it. We'll continue to monitor the situation, but it doesn't feel like it's a major long-term issue for us. Any other questions? Sandy?
Top of the morning. Back to this contract thing. So some of that 8.8 looks to have touched the long-term receivable.
Yeah.
And the thing that was in there was Sonar 2150. And well, I suppose I know you don't want to answer this, but when you say it's legacy, we're not talking legacy in terms of the production's finished, but kind of legacy in terms of the development is finished. Is that fair?
It's fair to say that those contracts have been running for some time. It's also fair to say that some of that 8.8 million relates to historic revenue that was recognised, actually about half of it, and some of it is is added to our provisions to cover future losses.
You know,
And the bit you're picking up on the suspense debt adjustment, that's the kind of historic bit.
Yeah. So the cash is kind of gone, and might have come, but doesn't disrupt things too much. And then just a sort of curiosity cat's kind of question. The higher discount rates we're now applying to goodwill, we've bumped them up quite a chunk to test the business's cash flows. Is that representative of the sort of increases in returns we're now asking the businesses to justify on new investment?
No. I think, there's more headroom on our cash generating units just because the businesses are doing better, not because we've changed the discount rate.
Right. I get that. It's just that you obviously, I was just trying to sort of work out if this is what's running across the business, whereas once a 15% return on the investment might have been acceptable, it's now got to be 16 or 17. So that's all I was trying to read into.
That's a fair point, Sandy. Actually, our businesses naturally generate much higher returns than our current return on capital. The reason for that is because a lot of our capital base is acquired intangibles and goodwill. Whereas if you kind of look at the underlying operating returns of these businesses, they can generate very good returns.
And I think in addition to that, Sandy, what I'd say is that we are not great believers in adjusting discount rates for investment proposals. We are great believers in those investment proposals highlighting all the risks and rewards of a project and all the mitigations associated with the risks and rewards of those projects. So whilst you won't see a material change in the discount rates we're applying to those projects, what you are seeing is a much more detailed assessment of what could go wrong and how you'll stop it going wrong. Because without doing that, you don't necessarily get management to manage those risks and indeed pursue those opportunities. And I think that's where you're seeing us be much more effective and rigorous in our risk assessment and the quantification of that and the reflection of it in contracting terms and pricing.
Cool. And then a dumbass question, but if the UK MOD, God forbid the DOD, were decided to go into quarantine for a month, how much would it disrupt, do you think, that regular flow required to get us the 29%, that isn't covered by the order book, if you see what I'm getting at? I'm assuming it's spares and small stuff that just comes in pretty constantly.
Well, I would add sonar buoys to that. So that quite often we will have sonar buoy orders that are placed and delivered in the air. I'm pretty sure that Russian submarines won't stop whizzing around the North Atlantic and the Pacific. But look, I think it's a risk, Sandy, for sure. I think it's not something that we think is going to materially impact the business. Certainly we're not seeing it at the moment, but we'll continue to monitor the situation and keep people informed as and when and if we see it. But so far, I don't think, with 70% order cover going into the year, it's as strong as it's ever been at Ultra. So.
Oh, okay, so there's nothing significant. And then, because I'm me, I know how difficult it is to change culture. If we were looking across, the largest 20 business units, has there been significant personnel change?
Well, there's very significant change at the top team. So all bar two of the executive team are new. I think it's fair to say we have seen at the strategic business unit level quite a lot of change. At the operating business unit level, it's not so much change in personnel, but it's change in attitude and approach that we're seeing. But this is a dynamic organisation, and we will continue to evolve, develop, and grow our people, hiring in from the outside when we need to optimise delivery.
But it wasn't disruptive in terms of slowing you down last year?
Well, not so far. But clearly, change is a challenging and risky thing to do, and the level of change that we're undertaking across Ultra, even given that it's a multi-year programme, is quite significant. So I'm sure there will be some issues, and indeed there are always issues that we will handle, but we don't see it being a major problem in 2020.
Thank you.
Any other questions? All right, guys, thanks very much for your interest, and look forward to seeing you in August, if not before.